So thank you all for taking the time out of your day to join this. It's a fascinating topic, huge issues at stake. And I would propose to start to hand over to Alessandro Barchietto to start us off on the webinar. So welcome to you all, and over to you, Alessandro.
As I was saying, it's quite a long time that banks have required to hold capital. The reason it's quite clear. If we look at the balance sheet of a bank, typically we have of a commercial bank. We have on the liability side deposits, bonds issued on the market, and other securities that are obligations, in the sense that has to be repaid predefined time and for a predefined amount. While on the asset side, banks have risky assets. In particular, they have loans that is not 100% sure will be in full repaid at the maturity, as well as other securities that for sure have probably a lower level of risk, but are subject to fluctuation in the market price. And so, I mean, also on the other asset, the fair value, the market value is not constant all the time. For all these reasons, in order to match the riskiness, I would say, of the asset in which the bank invests with obligation they have on the liability side, it's absolutely necessary that banks maintain a certain level of capital, not that level of capital that can be absorbed losses when it's necessary.
Thanks, Alessandro. So I think I'm due to pick up, and I hope you can all hear me. My name is Constance Usherwood. I'm Director of Prudential for AFME. And I'd like to run through where we stand at the moment and the key challenges of Basel III. So if we could move forward a couple of slides. Next slide. Thanks. So I'd like to start by going through the process of Basel III and implementation into EU law. Alessandro has already picked up on a couple of points, but essentially the great financial crisis showed that the Basel II framework was inadequate in a number of ways, and it needed improving to make banks more resilient to financial shocks in future. So Basel III is a process that was kick-started in 2010 following the great financial crisis. Many elements of Basel III were agreed soon after the crisis and have already been implemented. As you might be aware, these include higher capital ratios, leverage ratio, liquidity requirements, and these were included as part of CRR and CRR2 that were agreed and implemented in Europe in 2014 and 2018 respectively. So what we're looking at today is implementing the final elements of Basel III that were actually agreed in December 2017, and we're implementing them into EU law now as part of CRR3. In some respects, these final reforms were considered so far-reaching by the industry that they've been referred to as Basel IV. But I think for simplicity's sake, we'll just continue to refer to the package from now on as the finalization of Basel III. And so what you see on the slide is kind of the finalization process. In terms of timing, we're now in the process of negotiating and ensuring that the Basel III regulation is appropriate for the EU. And we expect this to be agreed, hopefully, depending on those assistants and MEP attaches and so forth on the call. We expect that to be agreed by the middle of next year. And that will then give banks a year and a half to implement. So I'd just note that some elements are so major, they have an implementation that goes beyond 1st Jan 2025, and we will learn more about that when we talk about the output floor.
Thank you, Constance. Well, the next session, we would like to give you an overview of the credit risk changes in this regulation. Credit risk is the bulk of the requirement, and as Constance has just said, This is to cover the possibility of loss due to the failure to repay a loan. So what we are going to see is how to assign the risk weights to the denominator of the capital capital rate. The higher the risk weight, the lower the ratio, and therefore it's going to be more difficult to reach to the minimum. And this is what we're discussing now. So basically, when we want to measure credit risk, we have two options: the standardized approach and the internal models approach. As you have already heard, the standardized approach is easier to implement. You don't have to make a model for that. You just look at some characteristics of your loan, things like whether it has a rating or not, the amount of the rating. You look at the loan to value, for instance, when you look at a mortgage. But when you have to use internal models approach, you need a very long historical data set. You need modeling capabilities. Basically, you take all the, let's say, mortgages of a similar kind you've had over time, and you estimate the probability of that given mortgage going into default in the following year. And then with that model you go to the supervisor for them to validate it.
This is Ennio Menicucci. I'm heading the Operational Risk Analytics and Oversight team in UniCredit, and I will drive you through the main changes regarding operational risk in the Basel III, Basel IV framework. So we can start from the next page, where we are just spending a few words to describe you the op risk capital calculation under the Basel II framework. So the current, which in the future will be the old one, the old one to be applied. Even in the Basel II framework, the capital calculation for the operational risk envisages the possibility to use, let's say, standardized or basic method, which are the first two here depicted, which basically allows to calculate the op risk capital using a relevant indicator, which is a sort of a number of business of the bank, applying a certain predefined percentage. But most relevant point to be highlighted here is the third method that is here mentioned, which is the so-called AMA capital. The Basel II framework allow banks to use internal model also for the op risk capital purposes. Of course, model that should fulfill some dedicated criteria and have to be then approved by the competent authority. But this was for sure, and this is for sure the most relevant point foreseen by the Basel II framework.
We speak now about, I would say, the second most important type of risk that banks face, and that is market risk. What is market risk? Actually, market risk is the risk of the changes of prices of assets that banks can trade, mainly financial assets like shares or bonds, but banks also can trade many other types of risks like commodities, like oil, gas, even pork halves, currencies like euros, dollars, and so on, gold, crypto assets, derivatives, even more exotic things like weather derivatives, mortality risks, and other exotic things. I think it's worth to mention the most exotic derivative that I have ever seen were jumping rates of breeding stallions that were traded. But that was before the financial crisis. Now banks are much more conservative with trading these kind of things. Also, what is important to mention in the beginning, when we speak about market risk, what makes market risk different from credit risk? It's much more short-term. When we speak about credit risk, as we heard before, it's the risk of losses because of the default of clients. Now we speak more about the risk of price movements, and that is much more short term. And whenever these kind of prices are changed, banks have to consider that in their P&L, and therefore capital requirements are needed. As banks trade so many different kinds of assets, it's important to have several subclasses of market risk, like interest rate risk, equity risk, commodities risk. But we are going not too much into detail to that today. Today we want to focus more on the boundary of the trading book, because that was not included already in the CRR2 package that was introduced mid of last year.
Third country branches is a bit a strange animal in the Basel III banking package. It has nothing to do with Basel. It's, I would say, a kind of leftover from the 2019 banking package, where these topics were already discussed, and now it came back on the table. The reasons for the harmonization is, until now, third country branches in the EU and also cross-border market access is almost entirely subject to national law. There is no EU minimum harmonization, or almost not. So Commission decided to bring in harmonization is the objective, to build up on existing national frameworks and to have a minimum level of European harmonization, and also to align with the EU requirements with international practices. So this is the reason and the objectives. I think we can move to the next slide, please. Yes, you see, there are 5 core elements of the harmonization approach proposed by the Commission. One is, as always in many European legal acts, proportionality. This means depending on the size of the third country branch in the EU, you have 10 different potential requirements applied. You have three categories: is class 1, class 2, and systemic.